Charting Your Way to Wealth, Chapter 7, Time Frames. When you look at a stock chart, what are you actually seeing? It is price movement within some moment of time. It may be what the S&P or the NASDAQ 100 did within the course of a year, up 50% or down one-third of its value. It could be what gold did last Friday or what bonds did last week. Time frames are important because they give us the ability to quantify and chart price movement during a certain period of time, thereby allowing us to determine what actually occurred. Analyzing multiple time frames of price movement in an underlying equity, that is a stock, index, or ETF, is even more helpful in locating an all-important price trend. Time frames are waves of price flow. The larger the time frame, the bigger the wave. The bigger the wave, the more powerful the time frame. Why? Bigger waves, that is larger time frames, have more inertia, move for longer periods of time, and equate to more profit. It should be self-evident that larger waves are made up of many smaller waves. Think about it. It takes 12 5-minute time frames to make up one 60-minute time frame. Now, the inertia of a larger chart occurs due to the past movement of smaller time frames. Over time, the smaller charts stack up enough energy to modify the movement of the larger chart and even change its direction. We have a default saying, all things being equal, the market tends to move in the direction of the larger time frame. Why? Larger time frames demonstrate larger trends. These trends have more inertia and tend to move for longer periods of time. When charting the market, you may use any time frame you wish. Through, however, tried and true effort on our part, we have chosen to use the weekly, the 2-day, and the half-day time frames. Why, you may ask? We have found these time frames working together provide us with the best trends and entry points for making successful trading and investing decisions. Please note, we are not day traders and these are not day trading charts. We look for trends on our weekly and 2-day charts and employ the half-day chart to view our smallest snapshot of the market. We remain cognizant of the weekly chart since it is our largest chart and, as previously said, all things being equal, the market tends to move in the direction of the largest time frame. Now, there are many time frames. We've chosen just 3. As you learn to read the charts, you can feel free to explore and experiment with other time frames. The one constant in the market is change. Be willing to learn our methods, but do not ever be afraid to try new things and other methods. Feel free to employ the ideas that you have. It costs you nothing to experiment and make multiple virtual trades all the time. You can also experiment with other ETFs, indexes, and virtually any and every stock in the marketplace. The bottom line, the reason we are learning to read stock charts is to make money. Never, ever forget this fact. We wish to locate price trends and jump into the flow so we can profit from the increase in the value of the stock or ETF. Commit yourself today and forever to stop using any technique that does not work or stops working. Your techniques must be successful time and again. The prior sentence is merely a statement of the obvious. I know that, but you wouldn't believe the number of people who, in spite of all reason, commit themselves to ideas, beliefs, and systems that are outmoded and don't work. Above all else, you must have a system to accurately assist you in determining if the equity being analyzed will go up, down, or sideways. This is simple and straightforward. Our system of charting is a starting point. It should not be your end point. Take our knowledge, grow with it, learn from it, and modify it to create your own system. Mutation, adaptation, and evolution are not dirty words. They are encouraged as long as they work. Each and every day at chartingwealth.com, we are here for you.